All right, I decided I'm not going to use my slides today. We're in a small group, so look, here's the situation that I think that's happening right now is that the marketplace went from making ICOs that are utility tokens that were unregulated, selling whatever to anybody they wanted, and they realized, maybe a little late, that it didn't work because they were breaking a lot of the security rules, and some of them got subpoenas, some of them didn't, some of them have to give all the money back to the investors, some won't, some will get into serious trouble with the Department of Justice, and it's a big mess. And so then they decide, you know what? Great idea. It's like a whack-a-mole game. Oh, if we can't do utility tokens, let's do security tokens. And so they came up with this new invention of a security token that really, if you think about it, is brand new, has not been done before, ever in the history of finance. And it looks like a genius idea. It turns out that the security token is a token that you're supposedly going to use as a service on a blockchain project as a protocol. So imagine if you're going to use a token that's a security to power, I don't know, a file storage system. And every time you use the token, you have to identify who you are. You have to do a know your customer. You have to verify that the person actually owns the token, was not stolen. It's impossible. And yet, everybody in this industry is talking about it and saying, oh yeah, security token is exactly what works. Well, guess what? This is not going to work too. We'll find out in a few months, same ways we did before. It's just not going to work. And so now you have a situation where you went from utility token to security token, and the investors who are making all those investments are either going to lose their money, get their money back if they're lucky, and it's going to be a mess. Because what's going to happen is that basically the existing exchanges that exist today that are called themselves exchanges are going to get shut down by the SEC. And then the exchanges, the trading marketplaces, not exchanges, because you can't call it an exchange, that are regulated as broker-dealers, ATS platforms, are not going to take security tokens because they have no governance. Wow, what a mess. So what's the solution really out here? Well, where are we going to go? So my view is this. It's pretty simple. The basic way to raise capital is to either sell equity, sell debt in a company, revenue share, a convertible note, which is debt that becomes equity, royalties. That's it. That's it. That's how it works. And if you go back to this basic and you issue equity or debt or convertible notes as a security token, as a token that's equity or debt-based, then it will be listed on the ATS marketplaces. A good example is T0. It's a company that is on the StartEngine platform. They are issuing a non-convertible preferred that pays revenue share. There's a revenue share. It's like a revenue share, net revenue. It has a bunch of terms. It's a great structure because, yeah, they'll trade it, of course, on T0's exchange and all of the other exchanges out there. Well, I shouldn't call them exchanges, ATSs, because exchanges, there are only 20 of them in the United States. It takes 5 years to become an exchange, like NASDAQ. So they're trading marketplaces. So if you think about it, the trading marketplaces are going to want to take these tokens that are issued as equity, debt, or revenue share that are well structured. The ones that are just security tokens that can be used one day as, I don't know, trading on some marketplace, another day you're going to use them on a protocol. It makes no sense. Imagine if you're going into Starbucks with a stock certificate of Starbucks and said, I want to buy coffee with my shares. How are they going to give you money back? I have no idea. And first they have to check that you own the shares, that you haven't sold them before, that you're the rightful owner, that you're not corrupt, you don't have I don't know, you have terrorism involved with you. It's ridiculous. And yet everybody is involved with this business, believes it's the way to go. I don't agree with it. I think it's going to completely change. We're going to go back to basics, where you raise capital the way capital has been raised before, except you raise it with the crowd. You do it with the Jobs Act, with all of the new rules that came out. There's this belief system out there that the rules are not clear, they need guidance. You hear that all day long, oh, they need guidance, we don't understand. That is totally wrong. The rules are actually very clear. They just don't want to follow them. So guess what happens? You don't follow rules, You raise capital, and then you're surprised you get into trouble. There should be no surprise. Any decent securities attorney will tell you right away, this structure will not work. The idea of governance is lost on everybody. They are talking about now token governance, which is great. That's governance on how the token will be used on the blockchain. But when you're a shareholder, governance means, are you going to issue more shares? What are my rights? Can I vote? What happens if you go bankrupt? Where do I fit in the repayment list? And then you have the justice system that can protect you in case there's fraud. That makes a lot of sense. We've been doing this for hundreds of years. And yet the whole marketplace today is talking about some new concepts and makes everybody look like a genius. Now, I will tell you, there's a book I read recently called Financial Euphoria that was written about, I don't know, 20 years ago, that really goes through every bubble in the history until then. And it shows you that everybody who comes up with a new idea is a genius until they're no longer a genius. And you know, when you talk about the security token, I had an attorney this morning tell me, you know what? It may be considered, if you go to court, as a general partnership participation, which means you're fully liable for the entire investment, not only what you invested, but also your personal assets as a general partner, which under the Delaware law makes you liable. So that's why being a general partner is risky and you get paid for it. If that's really true, that a security token can provide new forms of liability that people that don't know about it because it's going to be tested at court, can you imagine the disaster we're sitting on? That's why I urge the marketplace to really think basics, which is how to issue tokens as equity, debt, revenue share. Look at some other examples that have been done out there that are great. And then issue your second token, which will not trade, as a protocol token that doesn't need to trade because your first token is trading. So the people who are involved with the company, the shareholders, I would call them the employees, they all get shares in the company. They could be, you know, vested, not vested. All of this is up to discussion and full disclosures to investors because investors need to be able to make an informed decision. And if they don't have all this information, they can't make an informed decision, which is not very good for an investor. Certainly not good for the company if things go bad down the road. So my pitch here, really simple, is the marketplace has to really change its view, go back to the basics of how people invest money, provide the great opportunities for investments to the general public using the Jobs Act, which absolutely allows non-accredited investors and accredited investors to invest, and this will work for everyone. And I've been doing this for 3 years, not with ICOs, only recently with ICOs. And so I have a lot of expertise and background in this now. And I have to tell you, it's not difficult to do. It's simple. But it provides investors a lot of protections. It's not difficult to do. It's just people have got to a point where they were unwilling to follow the rules. And they call it, oh, we don't want dilution in our company. I mean, this is ridiculous. Dilution is not a big deal. It's part of a process of raising money. I've built companies in my past. One of them is Activision. Yeah, we got diluted. So what? It was very successful. We all got diluted. We all made a lot of money. Big deal. And when I hear all these people whining all the time by, oh, I don't want dilution, I look at this and say, you know what? Clearly, there's a mismatch here. Investors deserve to make a return on their capital. They deserve protection. And entrepreneurs need capital to build businesses. And this can be achieved absolutely with tokens, but it has to be done in the right structure. I guess I'm down to my last few seconds, and I'll be available here if you have any questions. I hope this is recorded because I'd like more people to see it and understand how I view the marketplace, and hopefully will enhance what's going on out there. Thank you.